This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Reaching back into the back catalog today, 3 very important back-to-back-to-back episodes. First, a trend-following trader who cut his teeth under John W. Henry, the famed trend-following trader who owns the Boston Red Sox. Number 2, an MIT professor who knows a whole lot about trading. And number 3, a former Apple programmer who shares some insights about how to get things done when you're dealing with one of the best entrepreneurs in the history of the planet. Like I said, back to back to back. 3 episodes, great insights. Jump right in. I hope you enjoy. My guest today is Ted Parkhill. He is the Chief Executive Officer of Incline Investment Management. Ted is all about systematic, disciplined diversification. A trend-following perspective for sure. And for those of you out there that sometimes say, I don't have enough trend-following guests, Ted brings a really interesting story going back several decades. I think you're going to find his insights, his perspective are quite grounding. Plus, he has the benefit of having a great story about his introduction into the world of trend following. Learning from working with one of the legends, the all-time legends in the fund management space. I hope you enjoy this conversation with Ted Parkhill. Ted, take me back to some early stages. So right now, you're a fund manager, but you didn't start as a fund manager. So I want to know, where did this market fascination, where did this start for you? What age? Give me an early experience. I don't know, teens, 20s? What was the transition for you? Or did you always imagine this when you were a 16-year-old kid?
That's a great place to start, Michael. I appreciate that because indeed it goes back that far. My background is I have 2 brothers, and my father was a broker. Of the 3 of us, I have an older sister too, but I was the one that was interested in the markets. Our dinner table conversation revolved around what was going on in the world, both from a business standpoint and a political standpoint. So it was anything political or business-wise was fair game. There were some subjects that perhaps we were somewhat of a traditional family we didn't talk about. But I had the opportunity to really be exposed to markets and trading. I grew up in a city where there was a commodity exchange, and I knew a number of people that were involved, and I had an early interest. In some ways, I might be have considered myself a bit of an Alex P. Keaton, to sort of reference a modern sort of era family ties reference there.
Go back in time, though. What city and what were some of these influences exactly hitting you that early?
I'm originally from Winnipeg, and it's an agricultural town where we have the Winnipeg Commodity Exchange. I'm Canadian and grew up in an environment where people knew what was going on in the markets, and I guess because of that influence, I sort of for my 18th birthday, I was given stock from a number of my parents' friends because they knew that was my interest. And believe it or not, back in those days, you kept track in a notebook of what you held, and so I kept that notebook for years of the stocks that I held, and so. Through university, I ended up studying economics because I was fascinated with how things, money and banking and how things worked in a more macro level. And I ended up, with my dad's encouragement and sort of as a mentor, I traded oil options while I was still in school and ended up paying for a year of my university. While that may sound impressive today with university rates where they are, My university was a lot cheaper back in those days, but it was sort of my opening to a world that was pretty fascinating for me. And had I known, I guess in some ways, I probably should have, and if I have a regret, I would have loved to have known about the floor trading in Chicago, because that's a place I probably would have gravitated to had I known.
What year would this have been roughly, Ted?
1985.
So right in the heyday of Chicago time, right in the heyday of Richard Dennis and whatnot.
Absolutely. And you know what? Growing up in Winnipeg, I didn't know a lot of what existed. And I guess in those days, you know, if you thought of financial markets, you moved to Toronto, you didn't move to Chicago. And so and ironically, this may sound funny, but I grew up on Harvard Avenue. And so at a very young age, I had sort of aspired to going to a really good school. My grandmother lived on Oxford Street. The next street over was Yale and Cambridge. And my paper route was on Cambridge. And I always sort of aspired to going to a really good school. Kid growing up in Winnipeg is, you know, that was a lofty goal. Eventually, I made my way to business school at Cornell in Ithaca and really, you know, thought that was a fantastic environment. I guess at a young age, knew that I would end up in business in some way, shape, or form. When I graduated from university, I ended up as an investment analyst. That was my start, actually, in the portfolio world. That doesn't come across. I don't talk about these days so much anymore, but that was where I started. What became very clear to me was, you know, the guys that did really well could explain what they were doing. And a lot of these portfolio guys were too sort of intellectual for their own good in a way. And I remember one of the portfolio managers I worked with way back when, he had an English degree and a master's degree in geography. And he did a fantastic job of explaining, you know, why he was buying certain things. And I was fascinated with that. I also worked for an early, what I would call a chartist. He was sort of before his time in a way. And you know, it goes back to the early 80s. And at that time, as you well know, some of the, you know, early CTAs were just getting started. And back then it was paper and pencil. It was almost pre-Excel. What was
his charting? What was he doing? What were you learning from him? What were you getting exposed to?
He was looking for patterns. And I thought that was just made a lot of sense. I thought that was really sort of, you know, practical and quite prudent, in fact, to look at history and history does repeat itself. And so, you know, I looked at all these guys doing all their research and the fundamentals. And at the end of the day, it became very apparent to me that all that was an opinion. And they only had an opinion based on the inputs that were available to them. Of course, it was right in front of me. These guys, if they thought they should buy something, they did. If it went down, they were convinced it was heading in the right direction, so they'd buy more. That didn't make a lot of sense to me at the time.
Did you have influences, though? You said it didn't make a lot of sense to you. Was that you just deducing as a smart guy, or were you being influenced by readings or outside people, or was that just kind of you in the light bulb moment?
Well, a little bit of both, but you know, wow, you're making me think from way back, because there was an article. Actually, I think it appeared in the Financial Analyst Journal, like way back, because I've thought about this recently. There was an article published in 1975 called "The Loser's Game," and that resonated with me very clearly because it was. And the simple example is you know, playing a tennis match. There are sort of two games. There's the pro game where they make winning shots, and there's the game for everyone else. And most of us are just lucky to get it back over the net. But the sort of the point of that article was that's all you need to do is keep getting it over the net and wait for your opponent to hit it in and make a mistake. And if you do that over and over again, you can be a somewhat average tennis player, but you can turn it into a winning game. My boss at the time, who's the chartist, recommended I read this article early in my analyst career. And I just thought that made a ton of sense. And in fact, to this day, I apply it to my tennis game. But I also think it applies to my professional career as well. And that is, you know, how do you become a professional and make winning shots? My career, my dad's advice was go corporate. So I did. I stayed corporate. He didn't think I should go into the brokerage world. And so I did that. But my career sort of took full circle later on.
Let me ask the big question, and we're gonna get to the current day, but I wanna infill some areas here. So we're going to talk about your firm's current strategy in a moment and perhaps some of the differentiation in that strategy. What's the first moment that you knew of the concept of trend following deep in your bones, exactly what it was, all the details? When's that first moment, and how did that happen?
It didn't happen till much later. I had my career path took a few tangents. I ended up in working in. I went to business school. Ended up working back in Winnipeg because I couldn't work in America. Ended up being recruited for a firm out of Florida, the Ivy Funds. I was a senior guy at the Ivy Funds, and I was still dealing with these portfolio managers that thought they knew better. And in my view, they were either goats or geniuses depending on the year, but it wasn't anything to do with their actual process. And it wasn't until the writing was on the wall that the U.S. subsidiary that I was working at for the Ivy Funds, it was Ivy McKenzie, it was about to be sold. And I realized that I needed to sort of, rather than wait around for the sort of the whimsical corporate decision, I should look around. And I had the fantastic opportunity to go work for a guy named John Henry, who was based in Boca Raton, Florida at the time. And I was living and working in Boca Raton. It wasn't until then, because I actually I didn't have the exposure. I didn't know about it. And yet it all clicked. When I arrived at John Henry, I had done my homework. I was really excited about, trying to get in there.
Oh, you done your homework. What does that mean?
Well, yeah, that's a good question. I started checking John out, and it was actually really hard to find information about him in those days.
What year are we at? Early
2001.
Okay.
It was really interesting to me because I couldn't figure out. To this day, I would suggest that John is a difficult interview because most reporters will ask Mr. Henry and say, what's his view on the dollar? And to this day, he won't have a view. And that surprises everyone. They just don't understand it. They'll say, they preface their question with something like, Mr. Henry, you've made a lot of money as a commodity trading advisor. So what's your view on the oil market? John didn't have a view. And that really interested me. And it really, that was really refreshing in a sense, because it was like, well, that's kind of interesting. How come? And when I started digging deeper to find out what his views were, that's when I thought, wow, this is sort of a breakthrough moment for me, because I'd worked with all of these so-called professionals throughout my career. I had perhaps become a little bit cynical in respect to their abilities. And so from my perspective, going to work for one of the pioneers in the space like John Henry, this was a critical moment for me. I was fascinated and I guess I could say hooked.
Let me dig in a little bit more here. So you're prepping, you're going to go for this interview. I remember I've been to that office. Well, it's not there anymore, but it was a Yamato Road, right? Right there in Boca Raton. Yeah.
You might not remember this, but I actually invited you to come.
But I'm actually thinking before that, with Mark there, I had got an appointment to go meet with Mary Beth Hardy.
Okay, that might have been, you know what? That might have been your first visit.
Yeah, this was really early. This was like mid-90s. And something happened and it didn't work out. But I remember going into that office for the first time. It was just a really interesting feel to be in Boca Raton, because I had been in New York City, weeks earlier. And you go to Boca Raton and you're like, where am I going? You walk into like this office park, cool building. And then you see that big board up and you're like, okay, why is he not on Wall Street? I don't get, it's all these questions start to happen. But for you, here you are, going in for this first interview. Talk about, you said you were doing all the homework about John. Were you connecting dots on the rest of his peers, for example, at that time?
No, I mean, it would have made a lot of sense had I been able to do that, but there was very little information. And I think that's where you've come in over the years, because you've sort of filled that gap. Back then, I found it difficult to actually get information on what was going on in that world. It was much, much smaller then. That while that's a logical, thing for me to have done, I remember it being very difficult. What I concentrated on, and this is somewhat of an ironic twist, I had, as we say up north, written the Series 3 exam, the Canadian equivalent. It's called the Canadian Futures exam. I wrote that when I was 22 years old for interest's sake, because like I said, I grew up in Winnipeg, commodity trading world. I was interested in the futures markets, and that stemmed from my oil options trading back in university. Come full circle, and I felt like I was somewhat prepared going into to my interviews at John Henry, because I actually knew about futures. And I knew about the futures markets, but as I said, my career had sort of taken a bit of a detour in the meantime. And so for me, it was kind of familiar territory. I was sort of coming home. What I had not had the exposure to in all of candidness was the concept of trend following was new to me. And yet it connected the dots for me. That's the part that I know once I started, I really, it just was so refreshing. It was a very exciting time.
I would be amiss, and I want to jump into here in 1 minute or two on your current day and start to dig into some of the nuts and bolts of strategy for your firm right now. However, I would be amiss if I didn't ask a few questions or get a few pieces of insight from you where you can pass along to the audience, the people listening. You know, we're talking about your first employment with a trend following firm, and it just so happens to have been with a trend following legend. He's now turned into a baseball legend. You know, he's made several $1 billion for himself. Quite a successful man. I met him one time, but what could you pass along, even though he's a very quiet man, demure, what could you pass along to the audience where they could say, okay, that's really interesting. Maybe I learned something there. What can you give the audience, Ted?
You know, you're right about Mr. Henry. He is a mercurial kind of gentleman. He sticks to himself and has what I would describe as singular interests. Like he's only got a few, and he's very deep in thought in respect to those interests. But I think some of the lessons that I learned working for him have resonated and sort of stuck with me to this day, and I think has led me in the direction that I've gone. And one of the things that John is really, really good about is and he would repeat this today, and I think it's sort of recorded in some of the work you've done and elsewhere, is that discipline is underrated. Discipline is a really key factor in what we do as traders, as investment managers. And you know what? I relate it to life. John's life is a very disciplined sort of organization. He runs his life systematically. And to some extent, I think I do too. I think maybe at sometimes my kids and my wife, I drive them a little nuts because I have systems to do things. And I apply that. I almost think philosophically, it's kind of like, do you make your bed in the morning and why? It's a certain sort of, I'm not a military guy, but I have a great deal of respect for the military guys. And there's a level of discipline in the military for a reason. It's repetitive. It matters. And I think that that's one of the key lessons that I acquired from working for somebody like, as you said, one of the industry legends.
One thing I was going to point out too, at least in my experience, and I think the Moneyball film did a pretty good job of this, at least in the kind of low key personality. But there are so many at the time when I was first investigating things. There were so many characters and big personalities. And look, you got a big personality in your voice. I know people might say that about me, but it'd be very different if John Henry was on this call. And I think for me early on, that stuck with me. It was like, hold on, this is not about necessarily some outward presence to the world. This is an intellectual chess match. If you're good at that intellectual chess match, you don't have to necessarily have the dog and pony show. The dog and pony show helps to get customers in and people know about you and all that kind of stuff. But if you're good and you can produce, the world seems to find you, huh?
I don't know if that's always true. I think there have been a number of really good, there's been good talent. But
I just mean he was very shy.
He is very shy. And one of the smart things he did was, though, he surrounded himself, or he hired people that could complement his his demeanor. And I think that's part of the talent. People don't realize, but he recognized that, and he hired people that could take the message to the market. And he hired people that did figure out that distribution had its value, and creating products so investors could access his strategies. And so I wouldn't want to underplay that, because I think that's an important factor, is that there's been you and I actually know some of these investors in the business. They're really good, but they haven't really made themselves accessible over the years.
Yep.
And so I think accessibility is a key factor, and I'm very conscious of that when I set out to build what we've done, I recognize that we can build it, but it doesn't mean that they're going to come. We have to allow them. It reminds me, Mike, of the old Monty Python sketch, The Cheese Shop. It's probably something you've forgotten over the years, but the guy, John Cleese, walks in and asks for cheese. And of course, there isn't any. And so you can build it, but you might be the finest cheese shop in all the land, but you've got to have product available to investors. And I think that's a key point for many, even some of the smaller CTAs and managed futures managers out there. A lot of those guys don't get that yet.
Well, just not to go off on tangents with other names, but I can think of a name in London who's probably the most respected trend following trader today and perhaps the highest earning, quite the character. And I think he did an exceptional job in the last 10 years of shaking hands and going out and talking and being a personality and explaining his world. And I think there's a tremendous number of lessons for everyone else in that from him.
Right, and that's a great example, in fact, because there's other examples out there that have done the opposite. So I really think that still is a part of it. And there's another piece to it in our business is that we are in, I don't know how to best characterize it, but I would still argue that we are not yet mainstream, that sort of our space is somewhat still an alternative one in a sense. I feel when I go to some of these industry events, it's a very collegiate atmosphere for the reason being we're all in this boat together. We all still have, I could talk to that gentleman you referenced in London, and he would talk to me because he knows where he came from, and he knows that we're in this boat. And I think you probably agree. I don't know, but
yeah, it's hard. I think it's hard for people to. This is such an interesting business. You can go from 0 to 60 really fast. You could go from being worth $1 million to $1 billion, sometimes very fast. It's really interesting in life to meet somebody that has done that trip, which, look, there's a certain bit of randomness to that, but to see them still be, to the extent they can be, when there's that many people that now want you, to see people still be normal when they hit such high marks. They still are regular people. I'm not saying all, quote, billionaires are regular people, but it is fun to see self-made entrepreneurs get there and, as you say, still be willing to talk and chat. It's nice.
Yeah, that's a great point. And the one thing is that it goes back to having a belief in what you do and why you've built it. And if you do have that belief, look, there are lots of different ways to invest money, and there are lots of different strategies. Some of them are better than others. And if you end up building your own, like we have, you end up having a very strong belief in what you're doing, or you wouldn't be doing it. I'm still fascinated because I actually think there are, of course, a number of different ways, and they're all valid in their own way or different timing, etc. I, as you said, it's an intellectual chess game. My partner and I are very engaged in that sort of way of thinking. I would put it, because when you're designing strategies, it really is about that. Like, what works and when doesn't it work, and how can you adjust? What do you build in to make it work is all part of it.
Let's shift into that right now. Let's shift into strategy. But first, I want to read something from a piece of your work, a quote that you cite. I love this. It's from 1940. So somebody out there right now is already thinking, I'm going to turn this podcast off because Mike and Ted are going to talk about a quote from 1940. The quote is, "Human nature never changes. Therefore, the stock market never changes. Only the faces, the pockets, the suckers, and the manipulators, the wars, the disasters, and the technologies change. The market itself never changes. How can it? Human nature never changes, and human nature runs the market, not reason, not economics, and certainly not logic. It is our human emotions that drive the market, as they do on most other things on this planet." Jesse Livermore, 1940.
It's a classic, isn't it? I mean, it speaks volumes in so many ways. Today we apply a lot of the intellectual, labels like behavioral economics, right? Which I am also fascinated with, because I actually do believe that, markets behave like people. They can't help themselves. And concepts like self-fulfilling prophecies happen because people start making them happen. If people start talking about the markets going down, they start to go down because people start selling, and it just repeats itself. From my perspective, I subscribed early on to this repetitive nature in markets. And from my perspective, it made complete sense to profit from those directional moves. It just made sense. And so when I, heard, I'm certainly not the first one to coin this phrase, the trend is your friend, or follow the market, why fight it? When I first heard those phrases while I was working for John W. Henry and Company, it just absolutely was crystal clear to me. It made sense. And yet I was, it dawned on me, but hey, there might be a different way of doing this. And over the years, I started to form my thinking relative to that. But when I see a quote like this, it absolutely nails it on the head. Things don't, change in a sense. It just repeats itself. The trick is, how do you capture that repetition?
Ted, philosophy. I'm looking at your work here. Markets are inefficient and therefore trends materialize. Now, you say markets are inefficient. Eugene Fama says they are efficient, and he has a Nobel Prize. Don't you like me just putting you on the spot, huh?
Yeah. Well, am I going to win a prize for my answer? That's what I want to know. That's a great. I am on the spot, but I think the way we put it is, there are periods of time where there are inefficiencies, and so do they normalize at the end of the day? One could argue and win a Nobel Prize for yes, but our position is that there will be a period of time where there is dislocation, there is directional moves. The trends materialize because things are happening in the marketplace. You can't have that statement without the second qualifier. And it's the second qualifier to me that makes sense of that first part, is that it's all about directional moves. And so the question then becomes, if there are, the question is, why do those directional moves happen? If they were perfectly efficient, we'd just see nice steady Eddie markets all the time. But that isn't what happens. And it goes back to the previous quote of Jesse and people and their behavior, embedded in markets. People don't behave rationally. The theory suggests they should, but they don't always. And so the question then becomes, how do you take advantage of those situations? And if you can do it profitably. And that's our perspective.
Ted, everybody wants to capture the trend, regardless of strategy. Everyone knows they want to capture Facebook from IPO to where it is today. That's a given. But here's what always stumps me is that if you just sit back and ponder for a moment and say, okay, I want to be able to capture Facebook from IPO to today. How do I do that? Now, what I don't get about the fundamental perspective is, how can anyone ever know all of the fundamentals? And if you can't know all of the fundamentals, doesn't it make sense to look at something simple like a price?
You definitely, absolutely, from our perspective, that makes complete sense. Your example is an interesting one. How can you know all about the fundamentals regarding a company like Facebook? I don't think the IPO and its reaction are based on the fundamentals per se. I would suggest or posit that there's a lot of emotion on the stock and the move and so on. Is the valuation even real? I don't know. And that was the first thing that sort of you grasp as a trend follower, is that if you don't know, then what do you know? From our perspective, the price at any given time is an aggregation of everybody's view in the market. Whether that's somebody is bearish or bullish, all those views are reflected in one factor, and that's price. And so from our perspective, and I would absolutely agree, you can't know all the fundamentals, and even then the fundamentals may not even make sense. So the only thing you can operate from is indeed price, and so that's absolute fundamental for us.
Let's talk about this for a moment, because I'm working on a new work right now, and I rethink how to describe the idea of just trading price. It really does take a light bulb moment to forget everything one has ever heard and just say, the price went from 5 to 7 to 8. I'm now going to buy it at 8. Because I have an expectation that the price might continue.
That's a tough one. And that comes from experience and years being involved in markets. I agree. I think that that's probably one of the reasons that more and more people don't jump into the business, because they haven't internalized that concept. You analyze the data and you analyze the markets and all the number of markets we trade, and over again, there is indeed repetition, and there are clear, definable, and recognizable moves, trends. And once you realize that, then trend following starts to make sense. But there's a key component that can't be left out. So much of what we do in the investment business, or what it happens in the investment business, I should say, is the focus on buying. There's very little focus on selling. Everybody wants to buy. And the traditional mindset is buy and hold. But what they don't tell you, and they don't teach you, is when to sell. And I think one of the really key aspects or components of what we do, the discipline that we've built into what we do, is that ability to sell. And we sell on an unemotional basis. We sell when the trend is over. Now, do we sell at the bottom or at the top or whatever, depending on what the direction of the trade? No, because we have no better crystal ball than anyone else. But we do know that the key aspect of trading as being a trend follower is that discipline of knowing when to sell. If you, to take your example for a moment, you know, it goes from 5, it goes to 7 and 8, and you get in at 8. If it goes back to 7 or maybe 6, you sell, you get out. As a trend follower, one of the fundamental sort of pieces to what we do is just to have that unemotional detachment, and your system says you're out. The fundamental guy would say, oh no, I know it's going up because I did my homework. And in fact, I'm going to buy more at 6. And they buy more of the dog that ends up going to 4. Whereas the trend follower protects capital because the trend follower will be out at 6.
People always seem to want to talk about or imagine the future. And then if you use an example of, like, let's say a past chart history, oh no, we can't talk about that. That's the past. Well, when we talk about the past from a trend following perspective, we're not trying to tell you it's necessarily going to be like the future. However, if one just observes charts and says, well, okay, here was an oil move that started in 2014. We didn't know where it was going to go in the middle of 2014. And then we look forward to early 2016. You can see this time and time again where there's just these huge moves. And if you're a person sitting out there that doesn't know how to trade these huge moves with fundamentals, my gosh, these simple ideas, the breakouts, the moving averages, of course, they can get a little more complicated depending on one's particular strategy. But there's very simple, robust type strategies that can get one into these big moves. And as long as you don't sit there, as you say, you're agnostic to the direction, as long as you don't sit there and question why the particular trend is going your way, as long as you're not concerned with why Facebook has gone to the moon and you're just happy to be on board and making money, then it's an okay deal.
Yeah, absolutely. You know, it reminds me, not everyone has the sports almanac from Back to the Future, right? We don't know how it's going to turn out, but I think it's that recognition, and it takes. It's counterintuitive in many ways. I think it's a maturation, because you know you've grown up when you can actually admit that you don't know what's going to happen. And in our space, and that I think it's common in our space, is that, you know, in trend followers in general, we're the first to admit that we don't have a crystal ball. We don't know what's really going to happen. And yet, over and over again, there are repeatable patterns, and those patterns, you know, we can track and profit from those patterns. The trick is, again, going back to and being a little repetitious, is just having the discipline to do that. To do that requires, as I say, sort of a maturation phase. You have to strip out the ego. You know, you might feel personally that, hey, this may be happening, but the system is saying, no, you know what, this is the direction. And having that ability to stick to what your discipline is, that's a key factor I believe in being successful in this space.
I'm looking at a chart right now, or a table from your presentation. It says over 70 global futures markets traded on 15 exchanges around the world. I know your staff is not massive, So, but even if it was, I'm looking at these names, and I think back to when I first started to get a grasp on this myself. But I'm looking at like, okay, gold, copper, other metals. Maybe there's some relation there. Sugar, orange juice, rubber, carbon emissions, the Hang Seng, the dollar index, 2-year notes, palladium, platinum. I mean, these things have nothing in common. And you, Ted, your partner, your firm, you guys are trading all of this. Now, I know how you're trading all of it, and I'm sure many of my audience does as well, but it's still quite amazing to be able to have a strategy that works on all of these different markets all around the world.
Well, it's amazing and exciting because you're right. Perhaps it's a bit misleading too, because it's very, very unlikely for us to have a position in all 70 of the markets that we trade. And so what a lot of people forget, they look at this and go, wow, you trade all 70 markets? And they automatically assume, because they're used to looking at lists. And so lists often are by definition, sort of all-inclusive, right? So they assume that we're invested in all at the same time. And it's not very, very unlikely in our case. The reason we trade 70 different markets that are completely unrelated is because we're looking for opportunity. We're trying to spot the markets that will be in a directional move. You know, one of the aspects of our trading is that we look at the market as sort of a basket, and we apply the same amount static risk to each of the markets we trade. And we think of that risk that applied to each market as static, and it is for us, and we don't reassign that risk to another market. So we don't load up if we do get a directional signal to take a position. We might end up with a handful, maybe 10 to 25 of the different markets, depending on what's happening at any given day or week or month. We'll have positions in those markets. Those are the markets that are moving. And that's where, so we think of it as an opportunity recognition tool. The average investor wouldn't have a clue to invest in the Mexican peso, and I'd highly recommend they don't personally invest in a single currency market or a single agricultural market or any metals, energies, whatever. And yet, when you hire a professional manager like us, you get exposure to markets that you would never have any chance of having on an individual sort of personal basis. And we give the investor the opportunity to profit from markets that they wouldn't have that exposure to because we're tracking them. And that's sort of the value added from our perspective. And at the end of the day, as you well know, Mike, is that the net result is, and many of us are in this category, I think, of delivering non-correlated returns with pretty much everything else that a typical investor would hold. To us, that was sort of the genesis, or what the point of the strategy was to build something that could deliver non-correlated returns. Because we still believe strongly that there's great value in providing something different. And there's a number of examples over the years when investors were very pleased to have had exposure to non-correlated investment categories.
I want to get into how you have split your portfolio up in a moment between a typical, perhaps one could call it something different, but a typical trend following portfolio and individual equities. But one more point I'd like to make on that diversification that you just mentioned. It's really tough for so many people, I think. They want to imagine consistency. And that consistency also is about the market, meaning whatever market it might be. They, in their head, they think it is better, perhaps, to be consistent and make money in a particular market all the time. Whereas in your strategy, your profits, month to month, year to year, could come from markets that are entirely different every month, every year. That's different. That's different for people to accept, because many people, how'd you do on the S&P? Like, it's the only thing they're looking at. So if the S&P goes flat, they make no money. I mean, it's the buy and hold strategy, right? But I mean, it's really wacky almost that people will fixate on one market to the exclusion of all other opportunities.
Well, it reminds me of the old axiom, mother-in-law research, right? But I'm going to leave my mother-in-law out of it, and I'll just talk about my own mother. And she still calls me and says, Ted, I saw that the U.S. market is up, so you must be doing really well. or the complete reverse, she'll call me and say, Ted, I saw that the U.S. market was significantly down, so does that mean you're doing really well? And every time, like I've explained it to a few times, right? But she has that mindset where she sees the market as the market, right? And so I think that's a fairly commonly held concept, or that's what most people see it as and understand it as.
Trend following will always be alternative as long as that is understood to be true by most people.
Yes, I think that's exactly right. And therein lies the opportunity for those of us that continue to do it. It's interesting to me because, and that sort of goes back to your earlier question, but why do we trade so many markets? It's because we are trying, a lot of these markets, think of it as like a farmer. The fields, the markets will be in fallow, like they're sitting empty. They're doing nothing. Or as we say in technical terms, they're neutral, or our position is neutral. But we think of it as having a position, even though we haven't reallocated that risk. The field is sitting there waiting for the next round. If that market starts to move either in a downward direction or an upward direction, we will then end up taking a position. And to us, it's just, keeping your powder dry so that when the opportunity hits, we can take advantage of it. At the same token, as I've mentioned, we are the first ones to automatically get out. And I think that is a philosophy that is shared by many of us in this space that is not well understood in what I would call the fundamental world. If you ask the average equity manager, of a long cap or large cap, large cap mutual fund, you'd say, well, so what are your stops? And I would suggest that the majority of those managers don't share the concept, and they don't think of it that way because they're basing their investment decisions on the fundamentals. Whereas for us, we don't have that ego invested in getting out. If we're wrong, we get out. And we take that small loss, the exact amount we were willing to risk on that particular trade. And so the way I like to explain it is in simple terms. And so perhaps this will help some of those that are listening, but we think of it as a P&L, like profit and loss statement. And about 60% of our trades, we lose money. And when you say that to the average investor or the average person at the cocktail party Friday night, they'll think, wow, they lose money 60% of the time? That sounds, like a crazy strategy. That doesn't make sense. How do they make money? And in our case, and I think you probably are following the bouncing ball, you know the answer. We know how much we're going to lose. And the easy math is if we lose $1 on 60 trades, we've lost $60. And yet on those remaining 40 trades, our objective is to, it's again with easy math, to make $2 on those trades. So we gross 80, we net 20. Now that's not exactly accurate, but it gets the principle across of what we're trying to achieve. And we can do that because markets move. And that's why having a disciplined strategy is so critical in what we do.
You made the comparison to other types of managers, fundamental managers that perhaps don't use stops or don't have a loss taking criteria. Maybe this is a little bit strong for you. From my perspective, I look at the trend following philosophy and I say it equals responsibility. There's personal responsibility built into it, meaning there's not going to be a bailout for a trend following trader, et cetera. But I think that's the tough part because these other types of strategies seem to be built on, and this is a tough word, a dishonest foundation because they're only based on the idea that everything can go up. And clearly, the S&P can go down 50%, or the NASDAQ could go down 77%. So it's really interesting that so many people have their net worth, their net wealth, tied up in strategies, tied up in advisors that are seemingly not 100% honest about what they might know about the markets.
That's an incredible comment, Michael. I actually am with you completely on that because that was a strong way of putting it. And I have a way of putting it. I call it the Morningstar paradox. And I'm amazed at some of these broker-dealers that avoid alternatives because they think they're avoiding liability. I think the opposite is almost true. But the Morningstar paradox is my theory about how the Morningstar style boxes have locked investment managers into the style, and they have no room to maneuver. Even though their prospectus may give them a great deal of maneuverability, they can't. Even if they get a message from above that the market is going down, and they personally may be going to T-bills, they remain fully invested. And they will continue to remain fully invested because that was what they were hired to do. And they don't dare run the risk of being accused of style drift and going to cash or anything else. They're stuck. And as an investor, you're stuck. And so the only way to get out is to sell the product. And then that actually ends up exacerbating the entire, the downward spiral. Again, creating opportunities for managers like ourselves.
But this looks great, though, to the average investor when you have, a bull market in stocks since March of 2009. Well, why worry? Hey, Ted, Mike, this is no big deal. Nothing could possibly happen. We have efficient markets.
That goes back to our original genesis. We saw, through the crisis, what happened? Well, real estate and equities tanked together. While positive correlation has positive connotations, it's not so good when you see both asset classes suffering badly at the same time. And what investors learned the hard way back in 2008 was, while they thought they were sufficiently diversified, they weren't. It was a big hit. And for those that were smart enough to hold on, and they've recovered in this massive bull run that we've seen since. I would argue that it's been exacerbated slightly by our friends Janet and Mario, but that's a whole nother talk, perhaps. The fact is, what was very clear from that was there are different, or shall we say, alternative ways of managing money. In that period, the category as a whole did very, very well. For me, the genesis was, well, investors still don't have enough exposure. How could we do it differently? Because what we saw after that was we saw some of the managed futures guys and the CTAs not do so well. So there's sort of an ebb and flow to the category. And so what we built with very, specific intent was to build something a little bit different that would smooth out that cyclicality that has tended to exist in the managed future space.
Talk about that. So and I mentioned it a few minutes ago, we didn't get into it yet, which is the idea of taking a, quote, typical trend following type portfolio and then combining with it, or at least 50% of that portfolio being in individual equities. Talk about that idea, how that came, that hybrid, how that came to be, and perhaps talk about the individual equities part of it.
It goes back to my partner Todd's and my shared philosophy. And when we met each other, we came together here in Incline Village where Ed Sakota was based. Todd's mentor was Ed Sakota, a name you know well. And Todd and I discovered pleasantly that we shared a great deal of similar philosophy and we outlook on markets in general. Post-crisis, we recognized that it did make sense for investors to have, in more diversification, and that they continued to have insufficient diversification. So we looked at a different way. And given the fact that we'd seen some cyclicality in the managed future space, we thought, how could we do this differently? And yet, we wanted to retain the benefits, the sort of what I would call the net benefit of managed futures, and that is that non-correlation. And to do that, we built what we call, our strategy is called the systematic hybrid. And it's a hybrid like the car. We have two, you could get technical, we call them alpha engines or quantitative approaches, but two engines like the car. And the first is what we characterize as being somewhat traditional, classic, medium to long-term trend following across the 70 markets like we talked about. And the second engine is we've applied our futures experience and philosophy to trading an individual basket of equities. To us, that gave us more opportunity to profit from equities that were moving. So we're obviously, by definition, you can surmise we're trading high beta stocks or stocks with high relative strength, to put it another way. And applying that same philosophy. Stocks that are moving, to take your example again, that goes from 5 to 7 to 8, are going to go to 10 and then 12. And we try and identify those stocks and invest directly in those individual equities.
Going back in time, I can remember years and years ago, people would drop me a line and they'd say something like, well, trend following doesn't work for stocks. And now I'm talking to you, and you've got an interesting background being influenced by John Henry, your partner, an interesting background being influenced by Ed Sakota. And now you're telling me that trend following for stocks does work?
So we spent a couple of years trying to figure it out. And I will state up front, we have not found the utopian solution for shorting the individual names. Very, very challenging on a number of levels. The stock selection process, the timing of the short, the sizing of the shorts, and on a number of levels. To apply managed futures trading philosophy to shorting individual names, very difficult. And we have not found that, what I call that utopian solution.
That is something that I've heard very typically over the years, where you can have the agnostic direction, long or short, on the futures side. But on the equities side, it has been pretty typical to have a long only bias. But the key thing being, if you have a long only bias on equities, you still have a stop, which is quite different than everyone else.
And we take it a step further. You're right. So the part that we could apply to our equity trading is we have a stop on every single equity trade. We took it a step further, and this is where we think it really adds value, and ultimately we think could provide some downside protection to investors ultimately in this engine of our portfolio. We took our experience and expertise on the managed futures side, and we've taken a stock index futures overlay. We like to call it internally, we call it the hedge. We will short the index. If there are signals coming to us that the stock market in general, the U.S. domestic market, is starting to drift down, the signal will come to the system, and we will initiate a short position on the market as a whole. We may still have long exposure in some of those high beta names. As those high beta names either get stopped or kicked out, depending on the criteria, eventually our equity engine could end up being in a net neutral position. As those equity individual names get kicked out or stopped out completely, that short will remain in place and will actually end up being net short on the equity engine. That's going to be very, very critical for us if and when the equity markets do start to soften up. By design, we are still able to go long or short. We just do it a little bit differently. And we think it's a much more prudent approach than most long short equity funds have, which tend to have a net long bias anyway.
It's an interesting conundrum, because I know in 2008, many trend following traders trading stock indices did exceptionally well. So it's a tricky thing. I think most people would probably agree that stocks have a bias to the upside, a bull bias. And I guess that's not surprising when you think about the typical mindset of most people. But when those down periods happen, boy, they can be sharp and they can be extended. And as I say to people, I seriously doubt the Japanese believe in buy and hold anymore.
That's great. That's we've seen the evidence. I've been around, as we covered earlier on, and my career goes back to the mid 80s, and I'm a student from before then. So I feel like I've seen quite a lot in my career. We know it can happen, and we've seen it, and as most recently as 2008, and here we are now in a full bull run. For us, our equity portfolio has been had a net long bias over this last period of time, and we've done, on a relative basis, we've done very well because of that. We feel good because we built something that works in the good times, but we have a very defensive mechanism built into the strategy that if it gets tough on us, we still stand a very good chance of doing well in tough times as well.
Ted, we're going to send people to Incline Investment Management. Your website is inclineim.com, correct?
It is.
I appreciate you talking today. Good stuff. I think people are going to enjoy this. I think we really kind of gave people a broad philosophical perspective and some details and maybe some strategy differentiations from your perspective. I think they can find a lot more information if they want to check you out, reach out to you again, inclineim.com.
Michael, thank you very much for the opportunity. I really appreciate being a part of what you do.
Thanks, sir. I appreciate it. Good conversation.
Thank you.
My guest today is Andrew Lo, professor of finance at the MIT Sloan School of Management. Andrew has a great perspective on many of the subjects near and dear to me. His newest work, Adaptive Markets, Financial Evolution at the Speed of Thought. You must read this book. Look, the efficient market hypothesis, come on, give me a break. You know in your heart of hearts it's not useful. Andrew digs in deep to present an alternative, an alternative way of thinking. And I got to tell you, this is where we should all be going. I hope you enjoyed this conversation with Andrew Lo. So, Andrew, the first time I saw your name, I want to say it was in a transcript. It was in a transcript, and I believe it was called the Greenwich Roundtable. All these great hedge fund manager names, Jim Simons, Toby Crable, Ken Tropin, all these guys that are seemingly with their work showing there's a problem with the efficient market hypothesis. And that was where I first saw your name was in those. And those are some great transcripts. I don't even know if they're available, but they're fantastic information in those transcripts. But let me take you back in time a little bit. I know and I've seen you talk about being in an event, the National Bureau of Economic Research, at an event in 1986. And you talk about there, and I'll let you explain too, but you talk about that your results were not accepted so quickly, so to speak. But even go back before 1986. Give me the starting point where you started to think to yourself, there's a problem with one of the most important precepts in finance and the efficient market hypothesis. Give me that foundation and some of those early experiences where you started to question things.
Sure. Well, it was an interesting time because I grew up in the tradition of efficient markets. And as a grad student, I was taught by a number of faculty that really the efficient markets hypothesis was gospel truth. And so I took it to be gospel truth. I certainly didn't have any reason to doubt it. But the thing that got me started down another path was the fact that I enjoy dealing with data and looking at numbers. As part of my research, right after I graduated, I decided to take a test of the efficient markets hypothesis by focusing on the random walk. Really, the idea wasn't to reject the random walk. It was just to come up with an interesting statistical tool. That was my ambition. And together with my co-author, Craig McKinley, we designed this statistical method that used a very specific property of random walks, the idea of a drunkard's walk. Can't predict where a drunk will go. If you apply that to this notion of the stock market following a random walk, it turns out that you can construct a very simple test using ratios of variances. And we thought we had come up with a pretty neat statistical test and wanted to try it out. So we just decided to apply it to the U.S. stock market. We were shocked to learn that according to our test, the stock market did not follow random walks. At first we didn't believe it because, well, we were taught in grad school that markets were unpredictable because of this notion of efficiency and randomness. And it really took us probably a good 10 years of various kinds of additional tests, refinements, and various kinds of counterfactuals that we had to rule out, that ultimately I came to the very uncomfortable conclusion that the random walk hypothesis was actually false.
What's really interesting about some of your writings is you are pretty open about academia in the sense the competition and how difficult it is to be an outsider, to get a view across. When you and Craig first started to have those aha moments, give me a sense of that feeling of looking at each other. I mean, was it one of those kind of things where you're both, young guys and you have this experience, you've done all this work? I mean, what was the emotion in the room? I mean, were you excited? Were you scared? I mean, what were you feeling?
Well, when we first came upon the result, we actually thought we made a programming error. So we had to go back and redo the calculations. And I remember very distinctly that Craig and I each replicated the calculations separately on our own, using our own software, and ultimately coming to the exact same conclusion. So we checked our results quite a few times before we ultimately came to the very uncomfortable conclusion that, the data really doesn't comport with this theory. So I think initially it was really disbelief. And then eventually it became a kind of a grudging acceptance that there's this inconsistency. And then for several years after, we tried to explain it away. We explained it away, we thought, with various kinds of anomalies. And one by one, as we looked at those anomalies, whether it was trading costs or asynchronous trading or various other kinds of explanations that really had to do with the details of market microstructure, we couldn't explain it away, and eventually came to that conclusion that, in fact, the theory didn't fit. But it was a difficult process for us because we were really raised in that kind of an environment. I ultimately had to come to the conclusion that what we were taught wasn't true.
Were there early experiences with other academics or even people on Wall Street where you, look, we're going to end up going down the path of your newest book, Adaptive Markets, but in the early stages, when you started to talk to people about your work and what you had found, were the reactions, I'm expecting there were some reactions where just go away? I mean, what was the, I mean, I saw the note about the MBER event, but speak to me about if anything comes to mind about an early conflict, perhaps.
Well, so certainly when we showed our colleagues the results, before even presenting it in a conference setting, our colleagues thought that we had made an error, and they just didn't buy it. So that's what prompted us to go back and redo our calculations. And then when we presented it at this conference with a number of our peers, they also didn't believe it. We were really, kind of taken aback. That was our very first academic conference, and we hadn't realized that there could be such controversy. We never expected to be part of that controversy. Over time, it became clear that we hadn't made a programming error, and the data really did show that the random walk wasn't consistent with market data. But it took a while to get there. And at that point, once you acknowledge the fact that the data weren't wrong, you had all sorts of uncomfortable questions that you had to deal with in terms of the consequences. And so we spent a fair bit of our early years as assistant professors working out those implications.
And that's the early foundation as we kind of bring it up to current day and your work, Adaptive Markets, and your hypothesis, your theory. Why don't I let you, from a big picture, the 35,000 foot look down? I can see, and I relate to so many things that you write about. They just, you can feel, okay, here's the influence of Daniel Kahneman coming in. Here's where these guys, here's where you have gone down the path to see that the efficient market hypothesis is not accurate. But what I like about the kind of big picture view, and I want you to run with this, is that this is more about, from your perspective, not viewing everything as a well-oiled machine that's just perfect. It's more about biology. It's more about evolution. Why don't I let you give your big picture view to the audience?
Well, economists have this view of the world that is very much driven by the model that physicists have developed. I often say that economists have physics envy because we wish we had 3 laws that explain 99% of all observable phenomenon the way physicists do. In fact, economists can't explain more than 5 or 10% of all observable phenomenon with 99 laws that we come up with on various different occasions. And it's terribly frustrating because we are fundamentally dealing with more difficult problems. I think Richard Feynman, the great physicist, said it best when he said, imagine how much harder physics would be if electrons had feelings. And, clearly we understand that the world is a much more complicated place because of human behavior. The idea behind the adaptive markets hypothesis is really to try to change that worldview, to change the view that economists have gotten used to of using mathematics the way physics uses mathematics. In other words, to try to model mechanistic systems that don't change over time and have these immutable fundamental laws, to a world of biological phenomenon where what we're dealing with are different species that are interacting with each other and that it's really the laws of evolution, mutation, selection, and ultimately adaptation to various different changes in the environment and to various species that drive market dynamics. So that's really what the adaptive markets hypothesis is. It's just taking the basic principles of evolution and applying them to financial market transactions and dynamics.
It sort of seems intuitive, maybe from the catbird seat of experience now, but it seems intuitive that when you look at some of the behavior, for example, we'll give the audience some color and think of some events going back to 1973, 74. You can think of 1987. You can think of the dot-com bubble. You can think of the Great Recession. None of these events, conform to any kind of precise model. They just look emotional.
I think it is intuitive, but really from the perspective of investment professionals, given your background and your experience, you've seen a lot of these non-stationarities and punctuated equilibrium events where markets can change dramatically over the course of just a few months or a few years, and they look nothing like the kinds of mechanistic explanations that mathematical economists like to use. But people who are steeped in the theory, namely academic economists, they get very wedded to their ideas. And so, part of the process of coming to the adaptive markets hypothesis was a bit of self-examination about how we as economists engage in research and dialogue with each other, the kind of mindset that we all have, and almost the sociology of our field has been part of the process of really understanding how it is that for so long we haven't come to terms with the fact that there are these disparities between our theories and the various different data that are out there.
There's the cross-discipline aspect here too. If you look at it, you're kind of like, okay, this very bright MIT finance professor, economist, is in the middle of dissecting financial theories, but at the root of that is thinking about things like sustained emotional stress just keeps us human beings from making rational decisions. It's a really cross-discipline to where you've gone in your work. Do you feel like that sometimes? You kind of think to yourself, wow, I'm going in much different directions than perhaps I thought I was going to go when I first started my career.
Absolutely. I certainly had no intention of cutting across these various different disciplines. When I first started out, I was perfectly happy as a card-carrying economist focused on all sorts of phenomenon that you would expect a good financial economist to think about. Derivatives pricing, risk management, investment theory, all of these ideas were really squarely in the domain of financial economics. What ultimately led me to these various different fields was the fact that the data that we were using to try to explain these theories just didn't fit. I wanted to understand why they didn't fit. I wanted to trace the origin of these discrepancies. And I guess as an academic, we're trained to be pretty stubborn in terms of trying to get to the bottom of things. I started by trying to understand the behavioral literature that emerged in the 1980s and 90s by psychologists and behavioral economists. I couldn't make sense of these anomalies because while they developed all of these different anomalies, they didn't explain why they were there or when one anomaly would be appropriate versus another. And so from the behavioral finance literature, I went to the psychology literature to try to see if the answer was there. And the psychologists didn't give any answers. They had many, many different theories that were, in many cases, mutually inconsistent. So then I went from the psychology literature to the neuroscience literature, because after all, behavior is ultimately generated by the brain. And from neuroscience to evolutionary biology and to ecology. And it was really just continuing my search for an understanding of how to reconcile the various different views of financial markets that brought me through all of these various different disciplines.
You know, even though you have put this work together that strikes at the heart of so many financial careers, you don't write in a way where you're not trying to hurt anybody, so to speak. You're trying to get to the truth the best that you can, seeing that there is these inconsistencies clearly exist. I'm just wondering, though, as you've been working on your book for the last couple of years, and it's come out most recently, you must have smiled, I'm guessing, when the Nobel Committee handed out prizes to Fama and Schiller in the same year. That must have caused you to kind of go, wow, they're kind of setting the foundation for, giving me a foundation to push off from. How did you feel about when that was announced?
Well, that's exactly right. I was delighted by that choice, and not just the two, but all three. Having Gene Fama, Bob Schiller, and Lars Hansen win the Nobel Prize, all for their work in finance in the same year, was, I think, absolutely inspired. And I couldn't be more pleased with how the Nobel Prize Committee formulated their choices. And I knew that there was a bit of a sense of humor and kind of an impish, mischievous humor in the Nobel Selection Committee's choices, because in the past, this has happened before, where in certain cases, they would select economists that had diametrically opposing views in the same year, almost to underscore both the importance and relevance of each of the theories, but the fact that it's still a work in progress and that we don't have all the answers yet. And I think that's exactly what they did when Fama, Schiller, and Hansen won. My interpretation of the three choices was, markets are efficient, except when they're not, and quantitative methods can help us to distinguish between the two. Those exactly are the three choices that they made. And you're right, it does set the stage for trying to reconcile these various different perspectives.
It's like giving carte blanche to say to the academic community, to Wall Street, do you have a way to, as you just mentioned, do you have a way to settle this? What are people thinking? It was almost a challenge issued.
There are different reactions of those set of choices. I think that one reaction that I've heard is that, well, this is clearly confirmation that economics is not a science if you can have two people who win the Nobel Prize in the same year saying the opposite things. And so I've heard that on a few occasions, but I think that that's a relatively uninformed view of economics. I think that more and more economists are coming around to my view, which is that it was a very inspired choice because it highlighted both the value of each of these schools of thought, but also the fact that we're not done yet, that there's still some very important kinds of reconciliation that needs to be done among the various different perspectives.
Let me take you back in time a little bit as we build out here. We start this conversation with the early 80s, your first presentation, 1986. I would like for you to go back and kind of give me a feeling of how your thoughts were developing when, for example, October of 87 hit, when the dot-com bubble burst, and when the Great Recession happened. Give me an idea of where you were at each one of those events in terms of your thinking and how each one of those events affected you, if not perhaps even just kept giving you more confirmation that you were on the right direction.
It was really the confirmation perspective that I think characterized those phenomena. Efficient markets hypothesis disciples would argue that prices fully reflect all available information. And so you would not expect there to be tremendously large price movements unless there was some kind of external shock. And October 87, nobody could really identify any kind of external shock that caused this massive crash. It wasn't as if there was some outside event or political disaster or a threat of war. It was just really an extraordinary change in the fundamentals of market valuation. That suggests that either the valuations on the previous week were way overinflated and now we're at the correct price, or it would have said that the prices today were clearly irrational and too low relative to what they ought to be last week. But you can't have it both ways. And so that was sort of the beginning of my sense that we really need a different narrative. And what that narrative is was a mystery at the time. It was something that I was groping at. one series of events after another started bringing more and more light onto the particular problem. It was really in 1999 that I think I finally started putting all the pieces together. This was, after LTCM, as well as the 87 crash, as well as a number of events in the market that really called into question, how people behaved. In 1999, I remember a very fateful trip to the zoo, the Washington, D.C., the National Zoo. I read about in the book where I was visiting the gorilla house because my son was just an absolute fan of gorillas, since one of his favorite books when he was growing up was Good Night Gorilla. At that time, 1999, he was 4 years old. So we went to the Great Ape House, and there was an outdoor exhibit with the gorillas. And I remember very clearly my son standing next to me. We were just beyond the reach of a very, very adorable baby gorilla who was sticking his arms out for some peanuts. My son approached that baby a little too quickly to give him peanuts. The mother gorilla immediately came over and grunted and was, quite threatened by my son's actions. As soon as that mother went to interpose herself between my son and her child, I immediately jumped in and grabbed my son and pulled him away. And at that moment, I realized that my actions and the gorilla's actions were not that different. That we were actually wired in the exact same way. And we reacted instinctively to protect our young. And that got me to thinking that the same kinds of explanations that we propose for animal behavior, that should apply to Homo sapiens as well. We are, after all, another species of animal. We may be more sophisticated. We may have more complex kinds of opportunities to change our behavior, but nonetheless, we share some very important circuitry. So that was sort of the beginning of the adaptive markets hypothesis making itself clear to me, and how it fit in with all of the various different existing theories that we were developing.
Bring yourself up to 2007, because as a professor at MIT with your specialties, summer of 2007 got quite chaotic. And then, of course, coming into the fall 2008, October 2008, give me some perspective, perhaps some feeling about, again, it could have just been more confirmation that you were on the right path. But did something come out of the Great Recession that added to your perspective even more?
Well, it did. And it actually started in 2005. So in 2005, I wrote an article. Actually, the article was first presented at a conference in October of 2004. It was an article that looked at the notion of systemic risk, the idea that the entire financial system could be at risk. The motivation for that was, of course, what happened several years before, 1998, LTCM, the fact that a hedge fund could create these kinds of shockwaves that ultimately threatened the financial stability of the entire financial system was really quite an extraordinary event. And so I spent a fair bit of time studying that leading up to 2004. Well, one of the things that my students and I discovered when we looked at the data on hedge funds is that from a variety of different statistical measures, we were seeing a buildup of leverage and illiquidity in the hedge fund space. And because we saw the impact of hedge funds.
What style were you guys looking at that time? What type of style of hedge fund?
Well, we were looking at all different styles. So the data that we had was from TAS, the hedge fund database, where they provided individual hedge fund returns across various different kinds of strategies. So we actually broke them down by 11 different categories that ran from managed futures and trend following all the way to convertible bond arbitrage, emerging market debt, and so on. And so we looked at each of these different categories. The category that we found the most interesting was fixed income arbitrage. Fixed income arbitrage was the category that was involved in the LTCM debacle. And what we noticed leading up to 2004 was that that particular family of strategies was becoming more popular was raising more assets, was becoming more and more illiquid using this illiquidity measure that we had come up with a few years before. We had a series of statistical models, factor-based models, to try to understand the risks in the hedge fund industry. And what we were finding, not just in that particular strategy category, but across all the categories, we noticed that assets were growing and the kinds of factor exposures, the commonalities among these hedge fund strategies, they were also growing, and that the correlations among these strategies, which were supposed to be relatively uncorrelated and great sources of diversification, we noticed that actually they were becoming much more highly correlated. All of this going into the end of 2004, and that's when we presented our results at a conference. We pointed out that hedge funds were becoming a much more important source of systemic risk, and that there was a concern of ours that we were going to see a repeat of 1998, but on a much larger scale. And so we first presented it in October 2004, and the paper we ultimately wrote and circulated caught the attention of a New York Times reporter in September of 2005. In one of the issues, I think it was the Sunday Times, one of the Sundays in September, he actually wrote about our paper, and the last paragraph was that the nightmare scenario that we were looking at was one of the hedge funds blowing up and bringing down one of the broker-dealers that lend to them. When that article came out, we were roundly ridiculed by former students and colleagues on Wall Street because they thought that it would be impossible for a hedge fund collapse to bring down a major bank or broker-dealer. That was in September of 2005. And of course, just a couple of years later was Bear Stearns, which was brought down by their hedge fund strategy, and the same with Lehman Brothers a year later. When the financial crisis hit, we had already been talking about it, and back in October of 2004, and then ultimately May of 2005 was when the first salvo was realized. May of 2005 was when General Motors downgraded their debt. And if you remember that time, that month, a number of convertible bond arbitrage managers all lost money at the same time. So that was one example of the so-called crowded trade phenomenon. And between 2005 and 2008, a series of crowded trades blew up one after the other. And that's basically what we had written about back in October of the previous year.
At that time, you were accessing data from TAS. Did you have access to data, or did you know the full scope of the trading activities inside the then four largest major investment banks?
We did not. In fact, one of the things that we had no clue about was what was going on in subprime mortgages. People had been talking about it, and there were a number of red flags that were being raised by various different pundits, including Bob Schiller and Raghu Rajan. But our focus was really on hedge funds and the data that we had access to. We didn't realize that what we were looking at was just part of a much, much bigger problem, and that the hedge fund industry ended up being the canary in the coal mine. They're the first to get hit. So as an early warning sign, the hedge fund industry plays an invaluable role in allowing us to understand what's going on with financial markets. And it wasn't until a year or two later, after all of these various different losses started piling up, that we began to put the pieces together.
Do you ever allow yourself, and I'm not asking for any kind of forecast or anything like that, but when we're at all-time highs, everything is just going swimmingly, there's got to be something in the back of your mind that says, what do I not know?
I think that we are heading towards a major dislocation. And I think part of the reason that you can tell this is the direction we're heading has to do with the combination of volatility in the stock market, the fact that it's near all-time lows if you take a look at an indicator like the VIX. But then when you take a look at various other measures like skewness, kurtosis, the volatility of volatility, these measures are all pointing towards some kind of a major event that may be happening over the course of the next 6 to 12 months. And I think that definitely is something that is worth watching.
Well, it's interesting as you say that too, and I want the audience to keep something in mind: is you're not attempting to say, some of these guys out there on assorted social media and whether, the finance channels making the daily prediction, you're more or less, you're looking at the data, you're saying, here are the extremes that we're seeing, and it's worth paying attention to these particular ratios given past historical situations.
Absolutely. I'm certainly no market pundit. I think Paul Samuelson said it best. He pointed out that economists predicted 5 out of the last 3 recessions. I think we want to be careful about making forecasts, but what gets me concerned and causes me to raise the red flag at this point is the fact that when observed volatility is low, the VIX being, what is observable right now, the implied volatility that market participants are using to price these various different instruments. What that suggests is that there's a complacency that investors have developed. When they feel that risk looks low, they will often start increasing the exposure to market securities and essentially bring their own personal portfolios up to the level of risk that they're comfortable with. If you're comfortable with 10% volatility and the market looks like it's half of that, you might be willing to take double the exposure. When the volatility goes down over time, investors start taking more and more risk, thinking that the risk in the underlying market instruments have gone down. But in fact, that may be a misperception. In fact, the risk may not have changed. It's just that there's a period of lower than average volatility, but it's likely to pop back up at a moment's notice. And I think when that happens, there are going to be some very, very rude awakenings. That's the kind of market disruption that I'm concerned about.
Hey, I would be amiss if I did not follow up. You mentioned Paul Samuelson, an early proponent of the efficient market hypothesis in an early form. That'd be a correct statement?
Absolutely.
And I think what's so interesting about him is he had this view, but then he also kind of had this really cool side gig called Commodities Corporation. And I
Right.
think that's so awesome, right? I mean, he was right there with a theory, trying to figure things out. But when it came to his money, he trusted the traders that he thought made the most sense for his money.
So I asked him about this. I was fortunate enough to be colleagues with him for a few years at MIT before he passed away. He was kind enough to invite me to lunch one day. And I asked him about this. I asked him about the origins of Commodity Corporation. He was very open about it and mentioned that when it first got started, the first year or two, they had used various different academic theories of supply and demand in order to try to make money in pork bellies and other commodities. They basically ended up losing money for the first year or so. And it wasn't until they brought on traders who were using technical analysis to trade that they started becoming profitable. This was a very, very strange situation for Samuelson to be in because he obviously didn't believe in technical analysis. And yet, his portfolio was doing just fine. So he ultimately, I think, developed a different perspective, which is that there may be microeconomic efficiencies while macroeconomic inefficiencies persist. And so that's how he sort of reconciled these two ideas. But it was something that I don't think he ever fully came to terms with while he was alive.
I love the great line that he has that I found somewhere that he thought Amos Hofstadter Sr., who died in a traffic accident in the 70s, he thought he was the greatest trader he had ever seen. I thought that was one of the great lines, just one of those things where if people are paying attention to the details, it shows that a lot of your work, I mean, right there, the fact that Samuelson, was an early proponent and involved in Commodities Corporation. Again, that's another foundational jumping off point for your work.
Right.
I want to talk some big picture stuff. People are going to need to go dig in. It's a really interesting read, Adaptive Markets. But I want to talk about big picture here because the idea of changing the financial culture, how do we make progress? And it's something that you point out in your work. which I think is really tough for people to accept, is the environment. Speak to when you want to bring people into your world, you want to bring them into the adaptive markets mindset. Speak to environment and the role that it's playing, because it's a really big role.
It is. And I think it's something that economists have not really focused on, and something that I'm hoping to change with the book. The basic idea is actually pretty simple. It goes back to what a biologist or an ecologist would say, and that is that when you start studying a particular ecosystem, you got to understand not only the flora and the fauna, but you have to understand the environment to be able to figure out how all the various different species relate to each other. And sometimes the environment is actually more important than the species that are populating that environment. A case in point is something that the economist / psychologist Herbert Simon proposed years ago. He once observed an ant crawling across a beach. This ant had the most intricate path that took it around puddles of water and across logs and underneath rocks. It seemed like the ant was navigating in an incredibly sophisticated way across an extraordinarily complex terrain. Simon asked the question, how does an ant with very, very little cognitive skills, certainly something that we would take for granted as inconsequential relative to mammals, how does an ant engage in such complicated motion? It finally dawned on him that it's not the ant's motion that's complicated. Rather, the complexity of the path is really a reflection of the environment. The ant may actually have some very simple rules, like if you run into an object, then turn around or go left, and then next time go right. It's really the environment that dictates the complexity of that kind of behavior. And so when we start thinking about individuals engaging in all sorts of very complex behaviors in the stock market, we have to stop and ask, is it something intrinsic about the individual, or is it really the environment that is causing that kind of complex behavior? The example that I give to investors is this notion of investing for stocks in the long run. We all tell investors that they should be long-term investors, that they should hold on to stocks for the long run and not worry about these kind of short-term fluctuations. That may be good advice, but frankly, that's just not credible, because when the market drops by 50%, as it did between 2008 fourth quarter and 2009 first quarter, when you see your 401k turn into a 201k, you are going to react. And the reaction is going to be freaking out. And what that means is that you can't be a long-term investor if you're worried that the short run is going to kill you first. That kind of market environment suggests that the kind of investment strategies that we propose investors follow, they're simply not realistic. They don't take into account the fact that investors are going to react, and that means that the environment is going to have an indelible impact on their long-term wealth accumulation policies.
There's a great line from Buffett where he says, if you can't afford to lose 50% in the markets, you shouldn't be in the markets. And I've been asking people recently, I've been saying to people recently, say, hey, where are you right now? What's your situation? Are you kind of passive index? Are you basically long only? And I said, can you imagine how you would feel if your current stock holdings, assuming you're in long only, all-time highs, can you imagine how you would feel if you saw a 50% decline or a 60% decline, or even going back to the 1999-2000 time period, a 77% decline in the NASDAQ? I don't know. I really, it's funny, even after March of 2009, it was such a quick kind of 6-month period, and then things got back to rock and roll. I don't know how people would react if all of a sudden the S&P was back at 1999 levels.
Well, I think that how they react is they freak out. And so this freak out factor is really what drives a lot of market dynamics. And the sooner we can start modeling those dynamics more explicitly, the sooner we'll have more realistic theories about how markets move.
Let me follow up real quick on one last thing here. You brought up the environment. I think I'd love to get your comment on this as well, too. when people, another way to think about the environment would be, okay, what type of particular return can I expect in a given year? Well, the reality is you really can't make that kind of guess. You just don't know. Mm-hmm. And I think there's something to the idea that if you can take what the environment gives you, and if your headspace is such that you're comfortable with what the environment gives you, you've got a leg up. Whereas the example that I just mentioned, people long all-time highs, if they're not even remotely expecting that the environment could give them something that they're, it's just not in the cards. But it's another way to think about the environment. I think it's a positive way to think about it if you can let yourself go there, and you doing your work, of course.
That's right. I think it's a very important point to change the mindset from thinking that the market is a kind of a machine that cranks out 6% risk premium year in and year out. I think that's a myth that's been perpetrated by both academics and certain practitioners. Those of us who are in the markets on a regular basis understand that there is no guarantee that you'll get any kind of risk premium. You can go for 3 or 4 years with a negative risk premium. And that's what most investors who don't do this on a full-time basis, that's what they miss. They seem to think that markets behave more like a physical system, like a machine, rather than a biological system. And the sooner they can think more along the lines of an organic, dynamic kind of a ecosystem where sometimes you'll do well and sometimes you'll get eaten, you have to really understand those kind of market dynamics. The sooner they'll be able to develop more profitable investment strategies for wealth accumulation. And it's not even just wealth accumulation, it's really wealth preservation, because it's during those periods of market trauma where you are reacting emotionally that ultimately end up really hurting the investor. It's when the short-run markets don't allow you to be long-term investors.
Hey, Andrew, one last quick follow-up. You mentioned thinking about the economy as a machine. There's this great video, and I'm sure you've seen it, Ray Dalio walking through the economy as a machine on YouTube. Mm. And obviously, Ray's had tremendous success. I think perhaps the largest hedge fund. When you see that, are we misinterpreting him? Are we taking it wrong? How do you feel when you see that video where he's walking through everything as just a machine? Because it's very different than what you're writing about in adaptive markets.
It is. And I think that there are lots of different views on how markets work, and his is one, and certainly he's had some great success. But then you talk to somebody like Warren Buffett or to Jeff Bezos or Mark Zuckerberg, and they've each made tremendous fortunes in very, very different ways. And so I think what that tells us is that there are many different forms of success, just like when you look at the landscape of the African savanna, you see that you've got zebra and wildebeest and springbok and tigers and lions, and many different species end up coming up with different ways of surviving and thriving in a dynamic environment. I certainly don't doubt that Dalio has developed a very successful formula. The proof is in the pudding, and you can see that from their success. But there are also many other investors that have taken a very different approach and have become equally, if not even more successful. And I think it tells us that there's a richness to the market ecology that we have to appreciate. There's more than one way to skin a cat, and we really need to understand the various different kinds of species that are out there and how we fit into that ecosystem before we can develop a better idea about what our role might be and how we can maximize our chances for long-term survival.
I think people can feel that in our conversation today, and that's really what you've done in your book, is you're basically just opening up Pandora's box and saying, let's all think about this. Let's look at this three-dimensionally. Let's look at this from this perspective. Let's look at it from that perspective. Let's just be transparent about the discussion and try and put our egos checked at the door. I feel like that's where you've tried to go.
It is. And if I'm successful, I think people will actually develop a very different perspective about financial markets. I've written it in such a way that it doesn't require any prior knowledge of finance. It really is meant to capture people's imaginations. For those of us who really are steeped in markets, it will provide some interesting conclusions to many of the questions that were raised. But for others who don't have any experience, I'm hoping that it's going to give them a different view of how financial markets work and how they might think about making investments in that kind of a dynamic ecosystem.
The book, Adaptive Markets, Financial Evolution at the Speed of Thought. Andrew, is there a website that we can send people to check you out, send you a million emails? I don't know. Is there any place where you want to send people to?
There is my Twitter page. They can follow me on Twitter. I do have a research page at MIT, so they can certainly look for me online.
Very easily found. Hey, thank you for taking some time today. It only took me a couple years to track you down, but as I said, I'm quite pleased to finally get you.
Well, thank you very much. It's been a pleasure.
I have one of those behind the scenes guests today, Ken Kocienda. Ken was on the ground floor right there in Apple's heyday, the golden age of Steve Jobs, directly responsible for the innovations, the insights that allow us to use, for example, the keyboard on our iPhone. Ken's background is amazingly not expected. A liberal arts guy. And in his work, he really explains that symbiotic relationship between software and product development for those that have never even thought about programming a computer. It's one of those behind the scenes accounts where you just say, wow, how cool that Apple pulled everything off. And even further, you can't help but say, even with all the positive things said so far, wow, Steve Jobs was an amazing guy. I really enjoyed this conversation with Ken Kocienda, talking his new book, Creative Selection, Inside Apple's Design Process During the Golden Age of Steve Jobs. I hope to have him on again, but to start, please enjoy our first conversation. So I was thinking, in preparation of this conversation, I literally went back to Wikipedia and I'm trying to figure out what was the exact first Apple model that I had. And I think 1990, it was either an LC or a Classic. I've never owned a PC. I'm a very, very biased interviewer for this conversation today. Never purchased one PC in my life.
Well, as an Apple enthusiast and a former Apple employee, I'm glad to hear that your biases run as they do.
I was thinking, though, back to the early 90s for me, as an Apple owner, a Mac owner back then, boy, I used to catch some flack. It was like, oh, you've got a toy. Isn't that cute? Look at the graphical interface, da, 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 da. And it was always this kind of snarky, snide, but that's not a real computer. That's not real technology. What you really need is this DOS screen. And I just chuckle now because it seems so like yesterday that the tech intelligentsia was DOS, 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 DOS. Boy, how times have flipped, huh?
Yeah, things really change. The technology does go through these periods where the accepted level of a professional tool changes. I think that, well, it's clear that before DOS and PCs became the accepted norm, before that, you needed a room-sized computer. Those lab technicians with the white jackets in the air-conditioned room with the raised floor, keeping those big pieces of iron running, were looking at those desktop machines and saying, what are you going to do with that? It's a toy. Personal computer. What are you talking about? Perhaps a simple way to sum it up would be maybe Moore's Law, but I think it's more than that. It's what people can get out of the machines and what design, the development side, it gives people as a tool. As the quality of the tools get better, what people can do with them begins to seem more toy-like.
I guess it's not surprising given to what we as outsiders know about Steve Jobs, but I can feel it in your voice already. And I think one of the themes of this conversation is the bridging, and this gets back to kind of making fun of DOS, but under Steve, Apple, it was the bridging of the liberal arts with the tech. And I can see that in your background too. Your background is not a guy that was sitting there like Bill Gates at 13, just coding pure code. You were living an interesting life in a lot of different things. And then you made your way to Apple.
Yeah, I didn't come to technology through any direct means. My only college degree is in history. I thought that I was maybe going to be a professor and teach the liberal arts. But then I also had this real love of photography. My parents had a darkroom in my house from the earliest age. I remember them developing pictures. They always had cameras. When I got older and in college, I also spent a lot of time in the art program and a lot of time in the darkroom myself. It was right at that point where, in order to do really high quality photography, you needed to use the old style chemistry. Digital cameras were just coming along. But again, I mean, going right along with along the same vein is those first digital cameras were toys. And now, of course, things are entirely different. So I had these different interests, but neither of them were in the direction of technology. It was history and photography and art. And then after I got out of college, I went to Japan and became interested in learning about different cultures elsewhere. I photographed a lot. I spent some time teaching English in Japan, and took all of that experience with me back to the United States and entered a Master of Fine Arts program for photography. But then there was a single night when I was in that art program where I was taking this elective where we were looking at what we could do with computers and photography. And the professor showed me the World Wide Web the first time.
What year? 93, 4?
Yeah, it must have been 1994, late 94. And so at that time, Yahoo was one of the first websites that he showed, but it was text only. If I'm not getting the dates exactly right, we could probably go back in the archive and see, when did Yahoo still have just a text only directory? And that's what I saw. And yet it was the most amazing thing. I went home from school that night and I told my wife, I said, "Hun, I just saw the most amazing thing, and it's called the World Wide Web." And soon after that, I decided I needed to get this in my life myself. So I actually went down to an ISP. I had to go down in person to an ISP, an internet service provider. I wandered into the office and eventually got somebody's attention, who then directed me to a fellow who was sitting in a cube, and I watched him open up a terminal window and type on the command line to add my account for dial-up. Went home and got a modem, and so it just goes to show how far we've come in a pretty short time, where the internet wasn't on all the time. When I wanted to dial up this terrific new thing, the World Wide Web, I had to dial the phone, dial the modem, and connect to this ISP that was across town in order to get these 14.4 speeds, kilobytes per second, and these web pages would take such a long time to load. Which again is just perhaps it's a long way of saying that I'm old, but it is another way of saying that it wasn't really that long ago where everything we take for granted today about the tech world wasn't quite there yet. You just kind of join that up with this other conversation about my background. Once I saw that, I went in steps to figure out, how do I get photographs showing up on the web, and then how do I make websites, and then programming for websites, databases and websites, and just one thing after another, I was doing programming.
My programming background started, and it never really went past web pages, but I hired a Russian programmer to put together my first website, 4 pages of static HTML, 1996, 21-year-old Russian programmer, $4,000. He built me my 4 pages of static HTML with a couple images. He then proceeded to disappear. I then had to figure out, how do I edit that code that I can't read? How can I make changes without breaking it? That was my reverse engineering process.
Well, it turns out that in my experience, that exact strategy was one of my best ways to learn new things. You start with something that works, that you don't understand, and you start tinkering with it, saying, well, if I poke it like this, if I poke the input this way, how does that change the output, right? And then you try to join up. If the output then doesn't look right, you try to go back to the input and figure out, well, how could that result? How could that change that I made on the input side produce that result on the output side? And then repeat again and again and again. I mean, there's no real magic to learning how to do something new, and I've found that throughout my career, learning and implementing tech, even at Apple.
Curiosity, probably the number one thing, right? You have to be curious about how it works. I can change this. I can tweak this. It keeps working. Oh, I can do this. I can make a better change. Boom, boom, boom.
Yeah, I mean, you have to want it. You have to want to figure it out and know how to do it. Try to explain to yourself how the technology works. And really, it is things like HTML and things like programming even in C or C++ or Objective-C or even Swift now, the Apple language of the day. All of these things are logical at their core. They're learnable, but you got to want it.
Let me get you to a terribly interesting book. I must say, I love the first person narrative. I don't know how you saved all these recollections to put it together and really kind of make me feel like I was there beside you watching this unfold. Quite fascinating, really. I mean, a great historical piece with timeless lessons for us. You've got an interview. You're going to Apple. It's a big deal. There's been a lot of success already. Put the date for me, put that interview, describe that opening day, that opening meeting, and then getting the acceptance.
Yeah, this was in 2001. I had worked at a series of startups before that, and none of them had been successful. And so I was looking to Apple as a safe haven, even though 2001, when I was interviewing, this was the late spring of 2001. So May, April or May. At that time, Apple had not even yet released the iPod. So the Mac was Apple's main product still. But as we were talking about earlier, with the dominance of Microsoft in everybody's mind and in the market, so Apple had a 5% market share. And so we think of today as Apple as this tech titan, but back then it was an underdog. And yet still, to me, in comparison, it seemed like this stable company that had products. And Steve had, by that time, he had returned to the company probably about 4 years earlier and had managed to turn the company around, and it was profitable. So Apple looked like an attractive option to me. So this interview, I was really nervous because Apple seemed to me to be a real company. And I had always loved Apple products from the moment that I saw them. My first experience with Apple computers was when I went to college in 1984. I went to college in the fall of 1984, and the Mac had been released in January of that year. Going to Apple was like, well, it was the big time. It was a famous company. It was much more nerve-wracking to interview there as compared to these startups. So I met a fellow there. His name was Scott Forstall. And at that time, he was a middle manager and was leading the team that was responsible for the user interface frameworks for Mac OS X, the new operating system that replaced the classic Mac operating system. To give some of your listeners some sense of what that means, if you're not a programmer or technologist, this was the high-level software, the software that put the windows and buttons on the screen. It was the software that in order to make it, you needed to work with the designers who would be designing the graphics and the animations and the look and feel of the system. So I was at that first engineering level underneath the designers, helping them implement and make the system usable and implement the features that would make the Mac intuitive and pleasant to use. So it was really nerve-wracking because I really wanted the chance to make a difference on these products that I had liked for so long.
And you did not know at that moment in time, I don't think there was any press or PR about it. You said pre-iPod. So you had no knowledge of the iPod about to come onto the scene.
No. And after that interview, I was hired, thankfully, and my job right away was to make Apple a web browser. Because at that point, Microsoft Internet Explorer was the default web browser for the Mac, and Apple wanted a web browser of its own. I was hired to do that along with one other fellow. That was our secret. And Apple is a company of many secrets and was so even back then in June of 2001, finally, when I joined. And so the iPod was released in October of that year, and I found out about it that morning. Steve had scheduled an event to announce something on campus. There was a press event that was videoed for the world to see, but then that was also broadcast on a closed circuit in the campus. And so there I was sitting in the cafe, which the tables had been pushed to the side and a little theater made, and I was watching on a big screen, and I thought it was amazing. 1,000 songs in your pocket. It was amazing. I dashed right back to my office from that event, and I ordered one immediately. Actually, if I just reach over here, I'm actually holding that very first iPod in my hand right now. I have it. I have it on my desk as a remembrance of that product that set Apple on the course to become a personal technology company, to transform it from a computer company to really the next level, where people out in the world are going to be using Apple products that they don't think of as computers.
Tell me if I'm wrong the way I'm going to state this, but the success of the iPod was like venture capital, but without the constraints. Meaning the iPod's success was the real capital base that then allowed, and we're going to have to kind of compress time here a little bit in the essence of time, but the success of the iPod was the cash cow that allowed the iPhone to take place. Was that the real source of the revenue coming in, or do I have that wrong?
No, I think you've got that right. And it was a base of resources. It provided this base of resources beyond money. The money was important, of course, because then it gives the executives latitude to try things. Yeah, you can then perhaps take a chance on something in the future without maybe running the company out of business. And of course, back in those times, people were still saying that Apple was doomed, beleaguered.
Let me interject one thing here, though. Big picture, a cash cow appears. A ton of money comes rolling in. Corporate America sees this publicly traded company. I mean, it took a lot of huevos to go ahead and not just be like Microsoft, to literally take all this money and then say, not only did we just give you the iPod, we're going to take the iPod, add a phone, add a computer, and come up with something that you can't even imagine. I mean, that took a lot of gumption.
Part of it was Steve's vision for the company, that he wanted Apple to be relevant to people's lives, in people's lives, to give people products that were meaningful and useful to them. The iPod was this step. Now music was in your pocket. Okay, that's pretty special because, I do, perhaps you do. I know most of the people in my family, circle of family and friends, music is a really important part of their lives. And so to have this wonderful part of what makes life worth living, what helps to connect things, maybe make you feel better when you've had a down day, put on a great song. And so that was wonderful. And so again, that was yet another part of this dynamic that Steve saw about how products in people's lives could give them these experiences that they didn't have before. Then the example also of the iPod as this pocketable device, and the knowledge and experience of manufacturing the products in their millions, developing the supply chain, developing the planning, The iPod in all of these ways was this springboard to the product that, the product that came next, the iPhone. And a tremendous amount of learning and self-education happened. And of course, then Steve was bold enough to take the chance, as you were saying, to apply some of these resources then and take a risk on, to parlay, kind of go double or nothing.
Steve announced the iPhone January 2007. So when did you know about it? When did the company put it in motion?
There was an effort that went on for some time, probably in the late 2003, 2004 timeframe. And I don't really know because there are other people who were involved in this and I wasn't yet. But the key technology that they were looking back in those earliest days that I just mentioned was multi-touch. What could you do to track multiple fingers and have the fingers become the input device to take the keyboard and mouse, put it aside, take the click wheel from the iPod, set that aside. So now you're going to be touching the content on the screen with your fingers. And so that was really a research and development project. Now, where I came in was just slightly after some others who then were told, yes, go make a product. We're going to commit to this in a pretty big way. And that we're going to try to make a whole touchscreen operating system, not just a demo, not just something that is a proof of concept more in the R&D setting, but we're going to try to make a product. And so when I joined, it was July of 2005, just about a year and a half before Steve was up on stage holding up an iPhone showing the world. I joined the team, and by that point, there were about 6 or 8 other software engineers and probably about 8 or 10 software designers. And again, like I described before, we were joining to make that top level of software, put the buttons on the screen, make the animations, give people the design, the interaction models that would make the touchscreen operating system work.
And what's so amazing about what you just said there, the buttons on the screen. Now, maybe young people, a lot of millennials won't recall, but buttons, little clicky chiclet type buttons, this was the BlackBerry. This was life for everyone. I mean, this was a huge innovation to go to the touchscreen.
Yeah, and this part of this is, well, all of us who are working on the software team had our own struggles in this area. My own struggle was to make the software keyboard. And what you describe about the BlackBerry and it being the model for everyone was really, it came to be the biggest challenge for me during that iPhone project was I had to make a keyboard in software, not in hardware. The iPhone was never going to have a keyboard like the BlackBerry. There were no designs to make the little chiclet plastic keys. The keyboard was always going to be in software. And the key aspect to that, sort of pun there, was that the keyboard could get out of the way. If it was in software, it could slide off the bottom of the screen. Thereby, when you weren't typing, that screen real estate could be made available for apps. And so you could play a full screen game. You could look at more email in your list, right? You can see a full screen photo. And so it really opened up the potential of the device to be something new and different.
Can I interject one point here too? And I don't know the exact timing of his statement, but just to put this in context about how revolutionary the project that you were working on, in particular the keyboard, you had billionaires, world-renowned billionaires, the heads of companies, guys like Steve Ballmer, who were pretty much making fun of the idea of this, that this could never be a tool for serious business people.
It's true. It's hard when you're shown something new and different, particularly if you have a psychological, an emotional, a financial, a corporate investment in the status quo.
How did you feel at the moment, though? Here you are, you're a relatively young guy. You're in the middle of creating a software-based keyboard for a touchscreen phone. You then can read the papers and read the magazines like everyone else. How was the enthusiasm kept inside Apple to where you could be so excited that this was going to happen and that you were going to top the thing that was out there that was making billions of dollars for BlackBerry. Was that enthusiasm kept inside on such, frankly, an R&D project at the moment?
We believed in it. We believed in Steve. Important part about the way that we made the iPhone is while we were developing it, we were using it to the extent possible. Now, for a long time during that year and a half, from June of 2005, when I started, to when Steve was holding one up on stage, when he did, and when people could buy one, you could put it in your pocket. For most of the time, we had this whole kit of hardware laid out on our desk, and we had these prototype touchscreens that needed a tether, a wired umbilical to this whole other hardware to make the touchscreen work. While we were working on the software, there were other teams, secreted away from us, working on the hardware to miniaturize everything and to get all of those components small enough so that you could put it in this small case. And so it was this challenge that had multiple levels to it. There were parallel tracks, and we had our challenges in software to make the touchscreen work. But there were similar challenges, which again, I don't have much insight into, but I know that they existed to get the hardware working. And all of us, we just believed in it. We had faith that if we just kept going, we were seeing the steady progress. So we just kept going.
I think it was your second demo with Steve, I believe, and this is for the keyboard. Can you set that stage? I mean, look, we can't describe it exactly as you do in the book, and the book is fabulous for laying that scene out. I felt like I was there. I'm not trying to directly sell you books, but I really felt like I was there with that scene of you on the demo for the keyboard and setting it all up. So here you're a guy that you've been working on this for a long time, and there's a whole process for how you will then present to Steve. Why don't you set that up to the best that you can?
Showing work to Steve was a critical aspect to our whole process because getting his approval was necessary. He was involved. He was involved in a way that's different than I think a lot of people picture in their minds. Steve did not write code. He didn't design graphics. Yeah, maybe he knew how to use Photoshop, but he certainly didn't produce designs by himself. What Steve was an editor. He created the assignments and then gave them out to his staff, eventually to people like me, an individual engineer writing code. Then he evaluated the work that came back. And how it came back was we had what I like to think of as a pyramid of demos. So whenever I did a little bit of work, I would create a demo, so a prototype, something that somebody could try that showed an idea that I had for a new software feature. I'd say maybe even use the keyboard as the example. So I made an improvement to the way that keyboard autocorrection worked. In order for that idea to move ahead, I had to put it in a demo that people could try. And first of all, the fellow in the next office would try it. He would give me feedback, and if he liked it, hey, maybe we'd move on. But a lot of times, most of the time, there was, a response. Maybe it could work better if you changed this or that or the other thing. Maybe there was a complaint about performance. Maybe the software didn't work fast enough. Maybe it worked well, but not fast enough. There was a bit laggy. But then from there, this process went on. So we had many of these individual, one person showing another person in the next office a demo. And once we got to a high enough level of polish at that level, it went up to the next level. We showed a manager of our mutual manager. Then it would go to that manager's manager. Now, we didn't have a lot of levels. There were only about 3 or 4 levels always between me and Steve. But eventually, it would get shown to the fellow that I mentioned earlier, Scott Forstall, who at this point, kind of fast forwarding from that interview in the first day in 2001, by 2005, he was put in charge by Steve to be the executive running the development of the iPhone operating system. So I'd show the work to him, and I needed to get his approval. And the approval of the other people on his staff, software engineering manager and the design manager, and then they would approve to show to Steve. And these were pretty formal very, very tightly organized, orchestrated demonstrations to Steve. Because one of the aspects of showing to Steve was he didn't want even the a tiny fraction of the description that I'm giving to you now. When he saw work, we had to show it to him almost like it was a product lying on a table in an Apple retail store, and he was a customer walking in from out of the blue without knowing a thing about it. He wanted to pick up the product and look at it and try it and see if he could figure it out without an engineer like me telling him about every nuance and every detail. He wanted the work to describe itself. And so then the last thing I'd say about Steve right now is that he could be really intimidating. If he didn't like that experience that I'm describing, he came in and looked at this work. If he thought it was not up to standard, he would say so. He could be kind of scary because his approval was so important. His taste mattered. His vision for the company and for the products mattered. For me, in order to get my work out into a product, it had to get through Steve and had to pass those rigorous standards that he held out.
I love this one line that I jotted down from your work. The demo was my question. Steve's response was the answer.
Yeah, that's how it was. He was like the great oracle. You would go to him as a supplicant bringing your question. And his answer was the word of the company. Now, there's another really interesting aspect of it. His word in the moment held, but he might change his mind, even sitting right there. Sometimes he would say a sentence, well, I don't really like that thing. Wait a minute, maybe I do. Because, again, when you're exposed to new work, sometimes things just hit you. And it takes sometimes a few seconds, sometimes a few minutes. Sometimes he would completely shoot down a demo one week and then come back the next week and say, I want to see that thing I shot down last week again because I've been thinking about it all this week and I can't get it out of my mind. There's something there that we need to explore. His vision drove a lot, and his vision was kind of like an example for the rest of us. We tried to, at each level down further in that demo pyramid, try to use his example in our demos. Try to be as rigorous and to have as high standards and to be as open to new work, but then also expect our teammates to give their best.
What I've loved about your work is that with so many movies about Steve, so many books, and look, the public, at kind of this 35,000 foot view, loves the tales of drama, the mercurial guy that might have been mean to someone or said something nasty. And I'm sure these things are true. And I'm sure there's probably ways, even in hindsight, maybe he wishes he could have said or done something differently. But what I always have thought to myself, why are we so fixated on those things? They've got to be the tiny elements overall. And I think your book lays out where the real detail was, the real genius was. Okay, no one's perfect. No human is perfect. We can say Steve got mad at people. Steve had a temper, whatever. But those things seem minor by comparison for the overall effort. I do find it interesting after all these years, people still fixate on some of those things, whereas I find where you've put the focus is so much more important.
Yes, Steve was focused on the products. That's what he cared about. He cared about making great products. The whole personal side of his life was something that he didn't bring to the office, but he did have an unwillingness to let social graces get in the way of efficiently pursuing the goal of doing the best possible work. One more little bit of color that I can add to the way these Steve demos happened is that they were very small. And getting invited to show a demo to Steve, involved a kind of a vetting process. When it came to software, Scott Forstall had to really give you the nod in order to get invited in to show Steve. And part of that was the belief that you had a thick enough skin that you could bear up under the pressure and that you would be able to help make the products better right in the moment. that you'd be able to think on your feet if Steve challenged you, which he did for me multiple times. He would ask you a question and then stare at you, expecting your answer. And if you gave a good answer, that was a really excellent way of getting invited back for the next demo. Giving a poor answer or freezing, maybe really smart people kind of begged off of demoing to Steve because they just didn't like the particular dynamic that Steve demanded.
It was a test in a way.
It's a test. It was a test to see if you could help make the products better in the moment. For me, getting that experience of spending time with Steve and seeing how he looked at products, how he thought about products, how he thought about them, watching the thought process happen. When I would put a demo out for him, this keyboard demo that you mentioned before, when we turned on the screen and he turned his attention to the keyboard, he looked at it for, it must have been, 30, 45 seconds without saying a word. And then he did this unusual thing, which I'm not even sure what it was, but I can speculate. He looked at the work straight on, and then he turned his head in like little figure eights. And it's almost like he was trying to see the screen in his peripheral vision. How would it change? He just had this unique vision and this completely individual approach to the work. And to me, it was inspiring in the moment and has been all these years later.
You mentioned also about that particular moment that he was completely present. Now, completely present for somebody who has spent a lot of time in a Buddhist country is kind of a buzzword. It's like a blinking light. I don't necessarily know if it's a blinking light for all of us Americans, but completely present is a real tell sign. Why don't you explore that a little bit more, what you meant?
He could concentrate and focus on just one thing. It was really just remarkable to see, because this demo, that day when I was brought into the demo room, he was actually talking on the phone when I was brought in. They had come to presumably had come to the end of the previous demo, and either Steve dialed the phone or received a call, and he just decided to take it. So they brought me in, and he was still on the phone. Even though there were a small group of us sitting there, 5 other people, 6 with Steve in the room, Steve was totally focused on his phone call. It's like we weren't even there. I mean, it was a kind of uncomfortable because there he is talking to, some important executive somewhere, presumably, just given what we could overhear. But you're trying not to overhear because you don't want to be eavesdropping on the guy. But he didn't seem to care. And then when his phone call was done, he puts his iPhone back in his pocket, because this was actually a demo for the iPad, so the iPhone was actually already out by that point. So he puts his iPhone back in his pocket, and he swivels in his office chair, and he turns to me, and it was like I was the only guy in the world. It was intimidating, but in a particular way, in that Steve had there's kind of this legend about Steve that he could tell you anything and make you believe it. And there's the funny little name that people call it, the reality distortion field. Steve could make you believe anything that he wanted because he just through this sheer strength of his personality. And yet, when he looked at me, it was like he flipped the switch on that. He reversed the polarity on this reality distortion field. And I got the feeling that there's no way I would be able to pull the wool over his eyes, even if I tried. Such was his focus. It was like he just banished all flummery. If you were a bag of wind, you would never make it through a Steve demo. You had to be, or try to be, as focused and on point as he was.
This is a great moment for a pivot, because everything you're describing is one instance, your situation, one aspect of the iPhone. But you lay out in your work this kind of what you call this evolutionary design model, this kind of Darwinian process that you guys kind of, pulled together. You call it creative selection. Kind of all this about incremental improvement. So even though you describe this one experience, this demo with the keyboard, we have to imagine, outsiders, and I guess you on the inside too, this was going on all the time, nonstop, improvement never stopping, and all aspects of the device, the iPhone. And Steve is the maestro doing this all the time.
Yeah, it was the culture, this culture of never really being satisfied, never being done with the work, always able and willing to go back and try again. And so, just a few words on this creative selection idea, this evolutionary design model. And it begins with a couple important ideas. Number one is when you have some notion, you get a dream, an inspiration to create something. We found that it wasn't enough to just step up to a whiteboard and maybe sketch it out and talk about ideas in the abstract. We didn't really do that very much. Instead, I would go back to my desk and I'd write a program and load it onto a prototype piece of hardware and then put it in your hands, give you something you can try that embodies that idea. And I tell you, those first efforts, those first prototypes were terrible almost all the time. And yet they did manage to show something, some aspect, some kernel of the idea. And that was the jumping off point. We would start there to then figure out ways to improve that demo. What could we do to make it better from where it was? Is it perfect now? No. Okay, then what are we going to change about it to make it better? And then, again, kind of this demo pyramid, get this feedback, gather up these responses, and then go make the next demo. Start with that first one, make the second one, try again, do another demo. Through this incremental process, round after round after round of refinement, that then stepped up to the managers, the executives, and then to Steve himself, we evolved great products from these humble beginnings.
The way you describe the culture, so different than your peers. Now, when you're inside and that culture is evolving and developing, this evolutionary culture, all this experience building on top of one prior experience, did you guys all know how different that was than all the other firms in Silicon Valley? Or how was that thought of inside the company?
It really was an embodiment of Steve's approach. He wanted to see demos. That's what he wanted. As a result, we developed this way to produce demos on a regular basis. That's kind of it. I mean, it's not like there was ever any deep realization that this was going to give us the results that we were looking for. It was really more a matter of Steve's asking to see demos. What do we do? Every Monday, he's going to want to come in and get a look at the latest software. So we need to make new stuff. As I think back on those times, it's like we engineered and designed our process at the same time that we were designing the products.
And then, of course, you've got the feedback from customers coming in too. And then you've got feedback from success. And then that starts to build as well in terms of the direction that you might continue to go.
Yeah, it ties into this aspect that you raised before about the iPod, this seed fund, this internal venture capital dynamic where you simply base what comes next on what's come before. I think that it was just a very pragmatic approach. We didn't think too much theoretically about what we were doing. It was all a matter of, okay, well, the iPod's successful. What comes next? Boy, we've learned a lot from it. And hey, boy, there's this multi-touch thing. And wow, batteries are getting better, and so are CPUs and GPUs. What interesting software might we be able to write? Yeah, just one thing leads to another. Whereas I think Steve had a vision, and I think that others of us, like me, tried to follow in his tracks. It was really more a matter of looking at the work in front of us, rather really than worrying about, is my vision up to Steve's caliber? It's really more a matter of, how can I improve this demo that I've got in front of me right now, and just keep doing that day after day. And that actually proves to be a pretty effective way of creating that vision, creating those wonderful results that you're looking for.
The audience will have to go take a read, but you described 7 elements to Apple's software success. You mentioned 1, inspiration, collaboration, craft, diligence, decisiveness, taste, and empathy. The 3 that I find interesting: craft, taste, and empathy. Again, back to my opening salvo with a liberal arts education. Those are not things that your typical kind of guy on the spectrum programmer at 13 would ever think about: craft, taste, and empathy. That is a completely outside the tech perspective.
We used certainly the word craft quite a bit. We thought about the care that we were putting into the work. I describe craft as using skill to achieve high quality results and always striving to do better. As a person writing code and working very closely with designers, we would sit there. I would sometimes sit there with the designer and we'd look at an animation that maybe lasted 0.3 of a second. Well, would 0.298 be better? And we would try it. And what about 0.250? Let's make a big move, right? 50 milliseconds was considered a big move. And we would try these. We would hone in from 250 to 300 milliseconds and maybe decide on one of those ends or something in the middle. But it was a matter of just iterating and trying and applying a craft person's approach to creating these digital objects.
I think you might know, maybe you're going to read my mind and see where I'm going from your work, but this chase for perfection, the craft, the perfection, you tie in something that people might not expect, which is the power sweep. And for those football fans that might not recall it, it's a little before my time too, actually a little before your time, but Vince Lombardi. So Vince Lombardi and putting together a web browser. Tie that in for people as we wind our time down.
I watched a lot of sports growing up, and you're right. Vince Lombardi is a little bit before my time. History is a big part of my background. I learned about him. And I learned about the way the Green Bay Packers played football in the 1960s and the way that Vince Lombardi turned around the Packers from a team that was mediocre at best for a dozen years or more. And within a couple of years, he turned them into a championship caliber team. And the way that he did it was he focused them. He told them, look, fellows, we've got one play that we're going to run. And we're going to run it again and again and again and again. We're going to hone this play and refine it. We're going to perfect it. So much so that when other teams know it's coming, the defense and the other teams knows that the offense of the Green Bay Packers is going to run the power sweep, that they're not going to be able to stop it. And this sort of goes against some notions of, right, Sun Tzu, right, all warfare is based on deception. And, offenses and defenses in sports are often modeled on that. But Lombardi said, no, if we can execute this play well enough, other teams won't be able to stop it, even though they know it's coming. And the aspect that I took away from that was the focus on one thing. And so how that relates to a web browser is that when I joined Apple, Steve Jobs gave me and one other fellow, and then eventually a couple of other people joined us, this mission to make a web browser for Apple. And he said he wanted it to be fast. And his idea was, well, Apple already had a web browser, Microsoft Internet Explorer. And if we're going to replace it with a new Apple browser, we're going to be taking an existing product away from people, giving them something new. Well, we're going to have to give them a reason to change, a reason to feel good about this new program that we're going to give them. So he challenged us. He said, I want you to make this new Apple browser way faster, much, much faster than Microsoft Internet Explorer. So go. Now, this is, again, an interesting insight of the way that Steve worked. What he said to us at the beginning of our web browser project was very similar to what Vince Lombardi told his football team. Hey, look, we've got one thing that we're going to focus on, and this is going to be the linchpin of our success. Building on that Lombardi example, that Steve Jobs example, we worked for over a year to just refine and hone the speed, this performance of our software. And by time we were done with Safari, it was 3 times faster than Internet Explorer. That achievement, I think, is a worthy one. It's good. But the key takeaway for me is that it was on purpose. It wasn't just luck. It wasn't just that it was a feature that turned out better than we expected. that speed of that web browser tied all the way back to that initial vision, that initial challenge, that statement from Steve, make the browser fast, just like Vince Lombardi told his football team.
I could sit here and pick your mind for hours. And I actually almost want to challenge you. It's like, yes, you've put down this book, but you could lay down your own podcast. You could literally, or I could interview you for hours and hours and weeks. Now, you're not going to do that, but it is one of those things where it's so much fun, and for, at least for me, to really kind of dive through your world, the world of Apple, and to kind of live vicariously through the experience and learn something, right? That's the whole goal here. What can we learn from yourself, from being at Apple, from Steve? You know, now that he's not here, what can we all take away and hopefully apply to our own lives, our own businesses into the future? And what can we do better? Because, you know, again, as I started this conversation off with talk of DOS and stuff, there was a period of time, I mean, my gosh, what would have happened and what would have been the development of technology if Steve did not appear on the scene? I tend to think over time, a lot of these, you know, graphical user interface advancements would have happened, but would it have been at the same speed? Would big monopolies have kept us in DOS forever? You know, what would have happened, right?
Yeah, you never know. There are no guarantees to how things are going to work out. There's a whole lot of luck and just serendipity. And Steve was here, and now he's gone. But he had a wonderful effect and set an example for how to make great work that through my book, I've tried to relate, because I got a little bit of a closer look at it than probably most, if not all, of your listeners. You know, now that that period is passing into history, I thought it would be a good idea to give voice to it and to show and tell a little bit about what those times were like.
Are there any companies or people beyond who is still at Apple that have really taken the Apple inspiration and gone those types of directions, at least from your perspective?
Well, it's interesting. I think that the culture of Apple continues. Things change, of course, and things evolve, and as they should. In some ways, it is maybe doing those companies that are really executing at a high level now, maybe even doing them a disservice to relate them back to Apple and Steve. What I'm looking for is people and companies coming up with new ideas and perhaps even new models for doing work that are going to make what we did at Apple seem like the Stone Age. I think we're all going to know it when we see it. I hope so.
Well, I got to tell you, as a guy who's done a podcast for 6 years, 700 episodes, if you could see my jerry-rigged situation for pulling a podcast together, I need the software engineering talent to tackle this scenario because it's not seamless to pull off a podcast yet. That's for sure.
You know, it's also a matter of testament. Use what works.
Yeah, it's true.
And focus your attention where you think it's going to give you the most benefit.
Absolutely. I don't try to have any bells and whistles. I want to use what works, be efficient, and if it's the best that I've got right now, that's what I do. Ken, I appreciate you taking the time today. The book, Creative Selection Inside Apple's Design Process During the Golden Age of Steve Jobs. Fantastic stuff. I appreciate you taking the time today. Where can we send people? Where can they go? What website? What Twitter handle?
My Twitter handle is my last name. That's Kocienda. If you want the book, you can go to your favorite book vendor and type in Creative Selection, 2 words. If you want to go directly to my website, it's creativeselection.io.
Ken, I appreciate you taking the time again. Fantastic stuff. Very cool. Thank you.
Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government, and trust Wall Street. This is absolutely not for you.